Hello, welcome to the Wealth Starting Line. Don't forget to like, comment, share, and subscribe.
Let's talk about gold. For 6,000 years, it has been so much more than just a metal. It's been in ancient tombs. It's been the foundation of our entire financial system. It holds this unique, almost mystical power. And right now, its price is absolutely surging, which has investors and even governments asking the very same question. Why? Well, let's dig in and find out.
So, really, what is it about this one element? I mean, why has it captivated literally everyone from pharaohs to central bankers to modern jewelers in India and China? So, in this explainer, we're going to break it all down. What is gold? Who's buying it? What's really driving its price? And maybe most importantly, what is it actually telling us about the state of our world today?
Okay, so first things first. To really get why gold is so valuable, you have to wrap your head around one fundamental concept. It's absolute, almost mind-boggling scarcity.
That's it. That is the number. In all of human history, we have only managed to pull about 210,000 tons of gold out of the ground. Now, that might sound like a big number, but let's try to put it into perspective.
I want you to really try and picture this. Imagine a cube, 22 meters on each side. Every single ounce of gold ever mined, every crown, every coin, every single bar sitting in every vault in the world, it would all fit inside that one cube. That's everything we have.
And here's the real kicker. For most of human history, we were barely finding any of it. The modern era of gold mining really kicked off with the California gold rush. But get this, the vast majority, we're talking 2/3 of all the gold that exists, was only mined after World War II. Today, production's pretty stable, which means the supply side of the equation is actually, well, it's very predictable. The real story, the real drama, is on the demand side.
So who exactly is buying up these 3,000 tons of new gold each year? Not to mention all the gold that's already out there and being traded. It really boils down to three main groups. And the breakdown is pretty fascinating. About half of all gold demand is for jewelry. That's right, jewelry is still its #1 use case. Another 40% is for investment, and that's both from big central banks and private individuals like you and me. And then that last little slice is for things like technology, dentistry, and believe it or not, even some super high-end food.
Now, when we talk about that huge chunk of demand for jewelry, we're really just talking about two cultural and economic powerhouses, China and India. Together account for a staggering 60% of the world's total demand for gold jewelry. It's just so deeply woven into their traditions, especially for huge events like weddings. Okay, now let's pivot to the second biggest buyer, central banks. And the scale here is, well, it's just immense. To give you a sense of it, just think about the New York Fed's vault. It's sitting 24 meters underground. It holds over 5,800 tons of gold. And here's the crazy part. A lot of it doesn't even belong to the US. It's just being held there on behalf of 36 other countries. But not all countries treat gold the same way. For the US and Germany, gold makes up nearly 70% of their foreign reserves. Now, this kind of makes sense for the US, right? I mean, it doesn't need to hold US dollars as a reserve. But then you look at countries like China and Japan. They hold a lot of gold, for sure, but it's still less than 5% of their massive foreign reserves. And that huge difference in strategy, that is a key part of this whole puzzle. And finally, you've got private investment. Gold has this incredible value density. You could, in theory, pack a $150 million fortune into a single large suitcase. But, and this is a big but, there's a catch. That suitcase would weigh 2 tons, about as much as a big SUV. And that perfectly illustrates both the appeal and the very real practical challenges of owning physical gold. Like, where do you store it, and how much does it cost to trade it? Okay, so we've established the supply is stable, and we know who the big buyers are. So what on earth actually determines the price from one day to the next? Well, this is where it gets really complicated.
The traditional thinking, the textbook answer, is that gold has an inverse relationship with other assets. So when the US dollar is strong, gold, which is priced in dollars, tends to get cheaper. And when riskier things like stocks are doing great, investors don't really feel the need for a safe haven like gold, so its price tends to follow then too. It's supposed to be a hedge. But here's the thing. Recently, that conventional wisdom has completely broken down. We've been seeing this really strange situation where both gold and the US dollar have been rising at the same time. So what's going on? This puzzle suggests that maybe, just maybe, the old rules don't quite apply anymore. and that there are much deeper forces at play. So it turns out there are these two kind of hidden drivers that often just completely overwhelm the fundamentals. First, there's just an unquantifiable emotional preference for gold. You could call it a pure love for the metal itself. And second, there's raw speculation. You know how it works. The price starts rising, it creates headlines, and that pulls in more and more buyers, creating a herd effect that can push the price even higher, totally disconnected from any economic data.
And, these hidden drivers create huge swings. Over the last 50 years, gold's average annual price volatility has been 20%. Let me say that again, 20%. That means, on average, it moves up or down by that much each year. That's actually riskier than the US stock market, which is probably not what most people expect from a safe asset. So if all those short-term price moves are mostly just noise, what's the long-term signal? What is gold's true role in the world? Well, you can think of it as a kind of barometer for the health of the entire global financial system.
Now, to really understand this, we need to look at one key concept, the real interest rate. It sounds complicated, but it's simple. It's just the interest rate you get on your money minus the rate of inflation. And gold has a very strong inverse relationship with this number. See, when real interest rates are low or even negative, holding cash or bonds actually means you're losing purchasing power. Gold doesn't pay you any interest, but crucially, it doesn't have a negative yield. And that makes it look a whole lot more attractive.
When you look at it through that lens, gold isn't just a commodity anymore. It's a vote on the credibility of the money that governments issue. Some analysts argue that rising national debts and these huge persistent deficits are creating deep cracks in the whole dollar-based system. In this view, a rising gold price is a clear signal of declining faith in that system. It's the world's ultimate vote of no confidence.
Okay, wow. We've covered its scarcity, the demand, the complex drivers of its price. So let's bring this all together and ask the big question. What does all this mean for you, for someone thinking about gold as an actual asset?
Here are 5 key things to keep in mind. First, you have to understand that gold moves in very, very long cycles, often lasting 10 to 20 years. Second, you have to accept that it's highly volatile in the short term. Third, if you're buying physical gold, be ready for high transaction costs. Fourth, because it doesn't produce any cash flow, it's almost impossible to value in a traditional sense. And finally, because of all these reasons, professional investors, if they use it at all, typically only allocate a small piece of a portfolio to it, using it to diversify, not as a core holding. Which really leaves us with this final massive question. Is the price of gold just a reflection of our 6,000-year love affair with a beautiful, rare treasure? Or is it something much more profound? A global alarm bell signaling a deep and growing unease with the very foundations of our financial world? And maybe the real story is that you can't have one without the other. The treasure is only a treasure because it's also the ultimate escape hatch.